Okay, my name is Peter Robel. I'm a managing director with the Berkeley Research Group, and I'm also the president of the UCLA Downtown Alumni Network Group. And this is our first event for 2017, and we're jointly sponsoring this with Latham and Watkins, specifically our Bruin friend Jim Barrall, and the UCLA Law School's Lowell Milken Institute. And we are honored to have Professor Kirk Stark, who is the Barrall Family Professor of Tax Law and Policy at UCLA's Law School. And he's going to give us an in-depth analysis of President Trump's tax reform programs and policies. And just briefly, Professor Stark teaches federal income tax, taxation and distributive justice, state and local tax, and is the first-year property course professor at UCLA. And he's been elected Professor of the Year by the law school graduating classes of 99, 02, and 09, and has received the university's Distinguished Teaching Award in 2003, and is the law school's received the law school's Rudder Award for Excellence in Teaching in 2008. His research focuses on taxation and public finance, with an emphasis on state and local tax policy. And in addition, Professor Stark is the author of War and Taxes, which is a political history of U.S. tax policy during wartime, as well as two leading case books, Federal Income Tax and Taxation and State and Local Taxation. So, Professor Stark.
Thank you so much. It is a real treat to be here with this wonderful audience. Thank you for having me. It's always a great pleasure for me to take time out of other people's lives to talk about tax policy. I am myself not a graduate of UCLA, unfortunately, but having now been there as an employee and on the faculty since 1996, I have spent, I think, more time at UCLA than at any other institution or location, including, now that I think about it, the house that we live in. So I definitely feel like a full-fledged Bruin. And our older daughter just started this year at UCLA. She is a freshman living in Hitch. And if you haven't seen the new Hedrick study, you should go on to Google Hedrick study video. There's a video of this, and you will be astonished at how unbelievably nice things are there now for how pampered these freshmen are. So we will soon, in the not-too-distant future, have a UCLA alum as part of our family, which is obviously a great joy for us as a family. I'm here today to talk about the possibility of tax reform in 2017 or in one of the upcoming years. We shall see. I thought I'd start with a little bit of a background on the structure of my remarks. I'm going to share with you some basic information about polling data on tax reform and the expectations that the electorate has for the possibility of some sort of change over the coming months and years. And then we'll take a look at some specific proposals, at least to the extent that we have information about those proposals, from the Trump campaign over the past year, from the June 2016 Paul Ryan, Kevin Brady House GOP blueprint for tax reform, that is likely to figure as a significant portion of any reform effort over the coming months. And then I'll also say a few words, although we have a lot less information about this, about the proposals coming out of the Senate Finance Committee and Orrin Hatch. And then we'll talk a little bit about whether any of this is doable at all. Yeah, Jim. Thank you. So I thought I would start by sharing a slide that I used in a talk that I gave last February, so almost a year ago, where I was talking about presidential tax proposals in the primaries and the likely scenarios for what was going to happen in Congress and the White House. And as you can see here, my political prognostication skills are perhaps, well, maybe they're exactly what you would expect from a tax professor. I had as the least likely outcome GOP president, GOP Senate, and GOP House. To my, I was going to say to my credit, but I can't think of anything that would follow that, except maybe this point about close 2016 margins, which I think it's fair to say we had some close 2016 margins, will likely accelerate the political salience of future elections. I think we're probably already seeing that everybody knows that there's a lot at stake with actual legislative changes. The whole world is watching what's going to happen. They're watching absolutely everything, every executive order, every tweet, every action of Congress. So all eyes are on what's happening in Washington, D.C. I was wrong about the rank ordering of likely scenarios, but I do think that that very last footnote, at least, was slightly accurate. Keeping that in mind, here's where we are today. It seemed like the most likely scenario was going to feature some sort of divided government. Divided government necessarily entails dissensus and disagreement about the way forward, and it's very, very hard to accomplish any kind of tax reform in the context of divided government. Now that we have GOP control of the House, the Senate, and the White House, as you can see here, we have thumbs up pictures of Donald Trump, Paul Ryan, Mitch McConnell, Kevin Brady, Orrin Hatch, and down there in the bottom left, I couldn't find a picture of Steve Mnuchin, who's the incoming Treasury Secretary, with a thumbs up. So that was, I don't know if you can tell, that was slightly photoshopped in the most amateurish way possible. What I'm going to do here, when we talk about the possibility of tax reform, is share with you some polling results from a few different polls, one from 2 years ago, which is a little dated now, but I think it's the most recent extensive poll we have about popular opinion on the possibility of tax reform and popular attitudes toward the U.S. tax system. And then we'll look at two very, very recent polls relating specifically to tax reform, polls that just came out in the past week. So in 2015, this is almost 2 years ago now, February in 2015, the Pew Research Center released this poll about the need and the perception of needs for reform of the U.S. tax system. And hopefully you can see this, but the basic point here, and none of this will surprise you, I don't think, is that the sentiment for completely changing the tax system is certainly skewed in favor of the Republicans. The Republicans are the ones who are interested in completely changing the tax system. No surprises there. The Democrats, there is some sentiment. There tends to be a stronger sentiment for changing the tax system, higher level of income. But the strongest sentiment is among conservative Republicans. And I think it's fair to say that conservative Republicans are now, for the most part, in charge. So the sentiment here is certainly strongly, both from a popular perspective and with the composition of the two chambers of Congress and the White House, pushing in the direction of some sort of complete change. What is it that people don't like about the tax system? People who want to completely overhaul the tax system, what are the features of the tax system that they find most bothersome? So here we have some data relating to the percentage of people who say that the following things are features of the tax system that they don't like. And you'll see that the top two there, where we have 64% of respondents say that the feeling that some corporations don't pay their fair share, 64% of respondents say that bothered them a lot. The feeling that some wealthy people don't pay their fair share is 61%. And then the complexity is the next item at 44%. Most people don't seem to feel, based on this 2015 study, that the amount that they themselves pay in taxes is too far off. Right? They don't feel like they pay too little. There are very few people who feel like they pay too little. But you might also read that as, like, I don't really feel like I'm being excessively burdened by the tax system. I think the wealthy and corporations are perhaps not paying their fair share. I'm paying about the right amount. There's also not a really strong sentiment that the poor are not paying enough. Right? You may remember the famous debate with Mitt Romney, 47% in the last election. That seems not here in 2015. There's not a really strong sentiment to say, we need to get this 47% onto the tax rolls. They need to start coughing up their fair share. Not a lot of sentiment for that. Of course, these things vary by party. But what strikes me about this, of course, the red bars here are Republicans, the blue bars are Democrats. The two highest bars relating to the feeling that corporations and the wealthy don't pay their fair share are, of course, coming from Democrats. Predictably, Democrats, 75%, 72% feel like the wealthy and corporations are not paying their fair share. But surprisingly high, at least for me, I thought this was sort of surprising, among Republicans. 52% and 45%, respectively, think that corporations and the wealthy are not paying their fair share. Complexity is much more of an issue for Republicans than it is for Democrats, right? And then again, the amount that the respondents themselves are paying in tax and the amount that the poor are paying in tax, not a major concern for most of the respondents in these polls. We get November 2016, right? So we go from this pre-election sentiment about tax reform, and all of a sudden there's this stunning outcome for most people, I think it's fair to say, certainly for me, with the election of Donald Trump in November 2016. Trump triumph shocks the world. Now we have, just released last week, a week ago today, a Pew study looking at what people expect about influence, political influence in the Trump era. Remember what we were just looking at about sentiments about tax reform and corporations and the wealthy. And notice the headline here. Public sees wealthy people, corporations, gaining influence in the Trump era. So let's look at that more specifically. Here we have 64%. These are all respondents, not broken down by partisan affiliation. 64% think that wealthy people are likely to gain influence in the Trump era. You can see the enumeration of the other categories of individuals. Let's see if we can break that down by party. Here, both Republicans and Democrats, certainly Democrats more strongly than Republicans, feel that wealthy people are going to gain influence in the Trump era. Both Republicans and Democrats believe that so-called business corporations, and there's a whole lot going on there, but this is just how the question is phrased. 70% of Republicans feel they're likely to gain influence, 80% of Democrats. And then a Harvard study that just came out a couple days ago looking at views on domestic priorities during the first 100 days. And there were a number of different topics that are addressed in this study. I just plucked out the ones specifically relating to tax policy to share with you here today. And here we have not Democrats and Republicans, but the general public, and then within the general public, Trump voters. So what do Trump voters specifically view as their preferences regarding tax policy changes in the first 100 days? Here you can see percent of Americans favoring lower taxes on each of these groups. 39% of Trump voters favor lower taxes on corporations, and only 18% of Trump voters favor lower taxes on upper-income Americans. Higher figures, perhaps understandably, for middle-income Americans and low-income Americans. So Trump voters, if you're reading this graph, you would say if you were designing a tax reform to meet the preferences of Trump voters, you might say it should be tax reform that should favor middle-income and low-income Americans, perhaps, one interpretation. This, I think, is probably more telling. What are Americans' beliefs about the effects of cutting taxes on corporations and big business? And here we see a very strong 62% majority of Trump voters believe that many new jobs and major economic growth will result from cutting taxes on corporations and big business, as compared to only 32% for the public at large. Right? If you put in the additional 24%, like we say among Trump voters, then we've got 86% of Trump voters believe that either many or at least few and some economic growth will result from cutting taxes on corporations and big business. A plausible position. As for cutting individual taxes, again, you can see Trump voters have pretty strong faith that this is going to have positive economic effects. Cutting individual taxes, cutting business taxes. Will it benefit them personally? Here, perhaps a little bit, right? But most people don't think the tax cuts will necessarily benefit them personally in terms of meaningful tax cuts. The hope, apparently, is that the indirect effects of tax cuts will benefit them. So that takes us then to what do we have on the table? Right, there are basically, at this point, a million different things going on. Everything's moving very quickly. It's changed even as I started putting together these slides a couple of weeks ago to today. I've had to sort of move some new stuff in and some old stuff out. And, so this is kind of a snapshot of where we are on Wednesday, January 25th, 2017. What is it, 5 days into, 5 or 5.5 days into the Trump administration. All of this, I think you'll appreciate and I'm sure understand, is pretty much at this point at 30,000 feet. Right? Where, campaign proposals are necessarily vague and general. So it's not like the Trump campaign put together detailed statutory language that was ready for enactment. These are big picture ideas with not a lot of details filled in. We have a little more detail from the blueprint for tax reform that was issued by the House GOP leadership in June of 2016. Speaker Paul Ryan and the Ways and Means Chair Kevin Brady. That's a full 35-page document that sketches out a path forward for tax reform. That is more detailed and, may well provide the basis for some kind of tax reform. But of course, in our constitutional order, no one person's perspective decides these things. We have the constitutional requirements of bicameralism and presentment, and so it's going to require everybody to come together. In essence, every actor has a veto over the whole process. Right? So if you can't satisfy Orrin Hatch, it's not going to happen. If you can't satisfy Paul Ryan and Kevin Brady, it's not going to happen. Mitch McConnell, it's not going to happen. Donald Trump, it's not going to happen. Right? You're going to have to come up with something that simultaneously satisfies the preferences of all of these political actors. So, keep in mind, of course, that these are proposals at this point, and really not even fully fleshed out proposals. But as you can see, in all three of them, with regard to individual tax reform, the general direction is the same, right? Reduce and flatten the rate structure and simplify, right? And this makes sense given what we've seen in the polling figures that, for the most part, Republicans favor reduced tax burdens, no surprises there, and they strongly favor reducing complexity of the tax code. And we'll take a look at what some of that might mean specifically. On the business tax reform, they're shooting in several different directions. There's a very underdeveloped, not ready for prime time set of proposals coming from the Trump presidential campaign about a 15% business tax that's not really fully specified. It's something about a 15% tax, but only if you retain the income in the business. What that means exactly, it's not exactly clear. There is a pretty fully specified proposal coming out of the House, which is the so-called destination-based corporate cash flow tax, which is a mouthful, but is probably the most interesting thing that's going on right now, is this replacement for the corporate income tax that's being called the destination-based corporate cash flow tax. So I'll say a little bit about that. Orrin Hatch has been fixated for the past few years on corporate tax integration reforms. This is a kind of inside baseball for tax policy folks. There's a Treasury report from 1992 that detailed some different proposals for integrating the corporate and individual income taxes. Right now we have two separate taxes, Section 1 of the tax code and Section 11 of the tax code. Each of them separately impose a tax, one on individuals, 11 on corporations. Of course, you pay tax on dividends, so there's sort of a classical double tax feature of the corporate structure, taxation at the corporate level and then taxation again at the individual level. These integration proposals would fold them into a single tax. And I'll say a little bit about that. So this is from, just to kind of use it as a jumping off point, from the June 2016 House GOP blueprint, what they view as a postcard tax filing that would be used in the system that's described in that blueprint document. As you can see there, it's 14 lines. If you could actually do this, it would be pretty impressive, right? There are a lot of lines that are on the Form 1040. I don't know if, where is Jim? Yeah, there you are, Jim. You probably have some 1040s that you could hand out to the audience here. Did you bring some extras? You would see there's a lot of lines there on the Form 1040 that are obviously not included on this postcard. And, so you might ask questions about things like, alimony. Where's alimony in this picture? Or IRA distributions, or student loan interest. I mean, there's a lot of those lines that are no longer here. It's hard to imagine that they envision just completely eliminating all of the rules for all of those things. So this is maybe a little bit of a fantasy postcard, but it's a starting point. You can see that it includes wage and compensation income and then 1/2 of investment income. And so we used to do it this way with capital gains way back in the day before I ever started studying the tax system. There was basically a deduction for half of your capital gains. But this takes all investment income and says, okay, we're going to only tax half of your investment income. It's a way of introducing a preference for investment income, interest, dividends, capital gains, etc., without completely excluding it from the tax base. Subtract contributions to specified savings plans, so presumably that includes all of the current familiar ones, 401ks, 403bs, individual retirement accounts, etc. Although there is in the blueprint document some discussion about an expanded version of that, and something that they call the USA, which is sort of coincidentally doesn't stand for United States of America. It's the Unlimited Savings Allowance. This is an old proposal that goes back to the 1990s from Senators Sam Nunn and Pete Domenici that allowed a comprehensive deduction for any contribution to a qualified savings account. Right? And you can see kind of what's going on there. We've moved a little bit in that direction over the past half century with 401ks and IRAs and such. Whenever you have a deduction for savings, right, if you think of income, what are the two things that you can do with income? You can save it or you can spend it. If you have a deduction for savings, what are you left taxing? You're basically taxing consumed income or consumption. Right, so all of these preferences, whether it's the excluding half of investment income from tax or allowing for a more generous deduction for contributions to qualified savings accounts, are sort of micro steps in the direction of a consumption tax of a sort, right? Different from a sales tax, different from a value-added tax, but anytime you reduce the tax burden on investment income, you're sort of moving in the direction of taxing consumption. Notice the deductions in this scheme. Deductions only for home mortgage interest and charitable contributions. Right? There are several other deductions that are currently available on Schedule A that are not on this list. One of which is particularly important in this room, in this community, which is what? Yes, state and local taxes, right? So Section 164 of the Internal Revenue Code allows a deduction for state and local taxes. Obviously, a provision that's most important in places that have higher state and local tax burdens. This would be California, New York, Massachusetts, New Jersey, Maryland, Illinois. What do all those places have in common? They're blue. They're very blue. Right? So this is a proposal that's likely to have probably more support among representatives from red states than from blue states. It's been on the table before. It was part of the proposals of the Reagan administration prior to the Tax Reform Act of 1986. They couldn't get it done, in part because Mario Cuomo, who was then the governor of New York, said it would be I forget what fiscal catastrophe or something like that. Fiscal Armageddon. I knew it was some type of catastrophe, but fiscal Armageddon to repeal. And so they didn't repeal it. All they did was repeal the deduction for sales taxes, which was then reintroduced in 2004. You subtract those two items, you get your taxable income. There's a somewhat more generous child tax credit. There's the earned income tax credit that we currently have. This Section 32 of the Internal Revenue Code is still in there. A new higher education credit. And then you calculate the tax. How does this differ from the Trump proposals? Well, Trump actually had some proposals that he initially put on the table in 2015 that were then revised in September of 2016 that moved in the direction of the June blueprint from the House Republicans. So that, I think, is telling that even before the election, at a time when it was not at all clear that Donald Trump was going to be the 45th president of the United States, September of 2016, he pretty substantially modified his tax proposals to move them more in the direction of the House proposals. Right? So there's been some convergence. Everybody that's talking about tax reform now is talking about what are the differences, what are the similarities between the House proposal and the Trump campaign proposals. One of the differences relates to itemized deductions. Right? The Trump proposal, rather than targeting specific deductions and eliminating them and retaining these two, would instead cap itemized deductions at $100,000 for single individuals and $200,000 for married couples. So you could, of this basket of potential deductions, you can deduct whatever you want. But once it reaches one of those figures, depending on your filing status, then the excess is no longer deductible. All right, so that's, you could imagine something like that perhaps being more satisfactory to the more targeted losers that suffer from repeal of state and local income tax and property tax and so forth, perhaps. On the other hand, that system eliminates for a lot of very wealthy individuals the marginal benefit of charitable contribution deductions above a certain threshold. Right? So we might eclipse some of the incentive benefits or effects of the charitable contribution deduction if we went with the Trump approach as compared to the House approach. There are also deductions for things that, do they really want to get rid of the deduction for extraordinary medical expenses, the deduction for casualty losses, right? These things that are long-standing features of our tax system that are not in this. Right? Maybe we do, right? They certainly add to complexity. Right? Even I can't remember, what is the AGI floor now under Section 213? Is it 10% or 7.5%? It's hard to keep track of this stuff. It's 10%, by the way. So here's the rate structure. Right on the left is current law. And, of course, we tend to obsess about the top marginal rate, but it applies to very few people in terms of percentages. But there it is, 39.6. There are 7 tax brackets under current law from 10 to 15, 25, 28. You probably can't read that. 33, 35, and then 39.6. And so this is the idea of flattening and reducing tax rates. And this is one of the changes that Trump made in September of last year. He had a highest rate of 25% under his previous plan, and his new rate structure that he proposed in September was identical to the House GOP proposal. All right, so that's one area of important conversion, is focusing, and this would be, a version of simplification, right? It is simpler, I suppose, to have 3 rates compared to 7 rates. But nobody actually sits down with a pencil and a pad of paper and calculates their tax anymore. It's all automatically done either on TurboTax or by your accountant or whatever. So, actually calculating the tax, you could have 468 rates, and it probably wouldn't be any more complicated than having 3 or 7 rates. Certainly it's the case that to the extent that there are disparities in the rates, that introduces planning opportunities, both for any one individual over time or for the shifting income among individuals, so that if you had just a single flat rate that applied to everybody, some of those planning strategies that are targeted at exploiting variation in the tax rates would fall by the wayside. All right, so that's an important element of complexity that's not complexity of the sort of how many pages are there in the tax code. It's just a feature of differential tax rates that incentivizes planning. These are the different breakpoints that you can see from the Trump plan. And one of the things that I'll draw your attention to here, which is a feature of the Trump plan that seems like it's likely to be attractive to a lot of different people, is what is sort of the de facto 0% bracket. Trump would very substantially increase the standard deduction to $15,000 for single filers and $30,000 for married filers. Right, so he would also, by the way, eliminate personal exemptions. And so that's a feature of the alternative minimum tax that we have now, which, by the way, everybody wants to repeal. But personal exemptions are not available as deductions under the alternative minimum tax. That means, so for example, I teach a case where there's a family that makes $80,000 a year, so not necessarily poor, but they have 10 kids, and they end up on the AMT. Why are they on the AMT? Because under the regular income tax, they get all these personal exemptions. The AMT, they get none, right? So to the extent that you think a tax system should differentiate tax burdens based on family size, the Trump plan, moves away from that principle, right? Whereas current law allows an unlimited number of personal exemptions. I don't know what the highest is. Must be some tax return out there in the world that has triple digits. I doubt it triples, but and you can see the top rate caps out there 33% versus the 39.6. A little bit about the business proposals. Like I said, the Trump campaign has this kind of pretty vague and underdeveloped notion that there should be a 15% tax. Apparently just said last week, within the past few days, that he's open to 20%. Right. So again, a little convergence, a little gesture perhaps toward the House GOP plan. This is the quote from the Trump campaign at some point. All businesses, small and large, that want to retain the profits within the business can get this 15% rate. Right, so that suggests that income that is not retained within the business would be subject, presumably, to the regular rate structure. But again, it's not like we have a statute that we can, even a proposed statute that we can look at and kind of try to figure out what they mean by that, how it would work. On the far right-hand side, as I mentioned, Orrin Hatch, there hasn't been a lot of detail coming out of the Senate Finance Committee, but there is this 340-page document from December 2014 that walks through all of the different options without expressing strong preferences one way or the other for both individual tax reform and business tax reform. Much of that discussion devoted to these corporate tax integration proposals of integrating the individual and corporate income tax. That could be done, for example, by allowing a deduction for dividends paid. Right now we have a dividends received deduction for intercorporate dividends, but when you pay dividends, the corporation pays dividends to its shareholders, there is no deduction for the corporation. By contrast, if you pay interest to bondholders, there is a deduction. Right, so that the current system skews in favor of leveraged corporations where they're allowed a deduction for the interest and away from equity. And so these corporate integration proposals, one of the objectives rather, is to bring greater parity to the treatment of debt and equity within the corporate finance structure, which certainly makes some sense. But as I mentioned, the most interesting proposal is this one. Right, it's the destination-based border-adjusted corporate cash flow tax, the DBCFT, as it sometimes is called. That doesn't quite have much of a ring to it. But it's quite interesting, so I thought I'd say a little bit about that. Let me check to make sure how we're doing on time. I think we're okay, right? I'm sure everybody here knows the most common tax on the planet is a value-added tax. Pretty much the entirety of the globe, other than the United States, it's a little bit of an exaggeration, but not much, relies heavily on value-added taxes. And I'm sure everyone here has traveled at some point and you've paid value-added taxes in France or Canada or Australia or wherever. And you've probably also gotten to the airport early in Paris so that you could submit the paperwork so that you could have your VAT refunded to you on your credit card for all the stuff that you bought in the Murray district, and that's a very common, exceedingly common form of taxation that we don't have here in the United States. Right? There's been talk for decades about the United States moving in the direction of a value-added tax. Nobody right now is saying we should adopt a value-added tax. Right? That's not a real proposal on the table from anybody, except maybe some academics. And so when I say nobody, I mean nobody. The standard design of a value-added tax is this one on the top, the credit invoice VAT, which is basically every firm that's operating in the economy, whether you're a corporation, a partnership, a limited liability company, whatever, you pay a value-added tax on the receipts, on your revenues, right? But you also get a credit for the value-added tax that was paid on your inputs. And that's thought to be a nice way to design it because you only get that credit if you can produce an invoice that proves that somebody else has paid tax on the items that you purchased for use in your business. Right? And notice that we're only focusing here on cash flows into the firm from stuff that you sell and cash flows out of the firm for stuff that you acquire. So all of the stuff that's happening within the firm is, what is generating the value added. That's not appearing on a tax return anywhere. So there's no deduction for wages in a value added tax. It's just receipts minus inputs. Right? These are the two different ways to design a value added tax. Either that credit invoice approach is the most common approach, or what is essentially the same thing but is slightly different, the subtraction method, which is you tax each firm on the receipts that they get from everybody else, from all other firms, and you allow a deduction for inputs. Right? Again, no deduction for wages, right? Just for inputs for payments that you're making to other firms. Right? Two different ways of doing the same thing, the credit invoice and the subtraction method. The flat tax, which you may recall from many moons ago, Steve Forbes and others kind of were pushing this idea of a flat tax, is often misunderstood in contemporary political discourse as simply a single rate tax on all income. Well, the actual flat tax, as originated from these two Stanford economists, Hall and Rabushka, is something much more clever than just a single rate tax on all income. It's actually very, very clever variation of a value-added tax. So remember how I said for both the credit invoice VAT and the subtraction method VAT, there's no deduction for wages. Right? So in other words, all of the tax is being paid by the firm, and wages are kind of embedded in the base. That's what's giving rise to the value added. Right? But there's no deduction for wages. So we're not taxing income, we're just taxing cash flows. So the sort of clever feature of the Hall-Rabushka flat tax was to take a standard subtraction method value added tax, this cash flow tax, but to allow a deduction for wages. Right? Now, why would you allow a deduction for wages in a subtraction method value-added tax? The idea then is to take that wage component out of the value-added tax base and then have a separate freestanding wage tax where you have household filing. Now, why would you do that? Because you might want to differentiate tax burdens among households, perhaps because of the size of the household, perhaps because of the total wages of the household. Right? You can introduce progressivity to the wage component by taking the wage component out of the value-added tax and having it as a separate tax in a way that you can't do if you leave the wage component in the value-added tax. Right? So the flat tax is actually, in point of fact, a progressive value-added tax. It's a slightly modified value-added tax designed to introduce some progressivity. Hall and Rabushka viewed this as a single rate flat tax. David Bradford, an economist at Princeton who tragically died in a house fire about 10 years ago, was attracted to the very clever concept that Hall and Rabushka developed, but he thought, there's no reason to assume that the rate would be flat. Right? We economists, academic economists, should be more agnostic about the political judgments that lawmakers make about the rate structure. And so in order to sort of convey that agnostic perspective, he insisted on calling it the X tax. Well, the X tax then became part of one of the main proposals in 2005 from the Bush Tax Reform Presidential Advisory Panel. So in 2005, President Bush commissioned this bipartisan tax reform panel, and one of their main proposals was the Growth and Investment Tax Plan in Chapter 7 of this document that was produced by this reform, these members of this Reform Commission. And it was a variation of the X tax. Now, it did some things that the X tax in its kind of pure form did not do, and so it was sort of derisively at the time known as a dirty X tax. This is truly inside baseball in kind of tax policy circles. Oh yeah, the dirty X tax of the 2005 tax reform panel. I remember that. But what it did, which was different from proposals for both the flat tax and the X tax, was it suggested that it should be destination-based. So the notion here was that we're doing something that's effectively a value-added tax. We've just kind of tweaked it in the following ways, mostly by excluding wages from the base. Right? So it's a type of value-added tax. Most value-added taxes in the world are destination-based, right? Meaning that imports are taxed and exports are exempt. Right? That's why you stop at the airport in Paris and get your VAT rebated to you, because that's the border tax adjustment that we're talking about. We're talking about exempting exports from the tax base. Right? And so the notion there is that it encourages, or at least does not discourage, domestic production. Right? Unlike an origin-based system, a destination-based system is designed to tax consumption where it happens. Right? So you take that scarf that you bought in Paris and you're consuming it in Los Angeles. Right? And so we're not going to tax you on that scarf. Right? That's an export from France. It's excluded from the base. So this Alan Auerbach, who's probably arguably the leading public finance economist in the country nowadays, at Berkeley, University of California, Berkeley, was involved with both the 2005 Reform Commission and has been the principal architect, this kind of intellectual originator of the House GOP destination-based corporate cash flow tax. Alan Auerbach doesn't have a partisan bone in his body. Right? So when people ask me, what do you think about this destination-based corporate cash flow tax coming out of the House that's being advanced by Alan Auerbach of Berkeley, my reaction is pay close attention to that. That's serious. Right? That's real tax reform. I've thought, if I'm going to write an op-ed about any of this stuff, one headline or title that comes to mind, of course they never let you pick your own title, is, could tax reform save the republic? And I kind of feel like there's an idea here that I think maybe people could get around. Maybe. Yeah, Jim. I like that, the Vat Tax, yes. Yes, I like the Vat Tax, although there's also the business activity tax that gets talked a lot about at the state level. So we'd have to maybe put an asterisk or something by it. So here's how it works. Right? As it's coming out of the House, the idea is it's a replacement. This is not a kind of wholesale replacement for the taxation for all business taxation. So right now it has a kind of incomplete quality to it because it's really designed to replace the corporate income tax. And this is, I'm sure if Alan Auerbach himself were devising this, it would be more comprehensive in its scope. But right now, it's designed as a replacement for the corporate income tax, only applies to corporations, not LLCs, not partnerships. Single rate, as we said, 20%. Probably the key feature, aside from the border adjustments, the two key features would be eliminating the whole concept of depreciation. That's now irrelevant. No more of this business about what's the useful life of the asset, and are you using some sort of accelerated depreciation, some of the year's digits, and all these things. If you're a tax person, you're having nightmares about learning all of this stuff. It's incredibly complicated. That would be rendered irrelevant in a world of this new destination-based corporate cash flow tax because of expensing. What does expensing mean? That means immediate deduction for all payments. Would the rules of GAAP around depreciation change too? I can't think of why they would need to, but it's possible. I mean, those rules are designed for a different purpose, which is to tell us something about the earnings of a firm. Right here, we're no longer. It's like whatever pretense we ever had about measuring income, we don't really care about that. What are we trying to do here? We're trying to raise revenue in a way that we think is positive for the country. Right? We would retain the deduction for wages. So this is the key difference from this tax and a value-added tax, is a deduction for wages. And oftentimes in the sort of academic literature on this new tax, you see this deduction for wages described as a subsidy. Right? And it is a subsidy of sorts. It's like a 20% subsidy for wages, but whenever you use the word subsidy, it has to be kind of relative to some baseline. And the baseline here is if we had a value-added tax would not feature such a deduction. Right? So it's like a value-added tax, but with a subsidy for wages. Right? So it's only a subsidy in that kind of limited conceptual sense. But it's important, I think, because you can sort of sell it as having progressive features. Right? It's less regressive than a value-added tax because it retains a deduction for wages. Right? Whereas one of the reasons why a value-added tax is regressive is because there is no deduction for wages. Right? And of course, consumption, low-income households consume everything. High-income households save a lot. Right? So relative to their income, a flat-rate consumption tax is necessarily regressive. And then it's destination-based. Right? So in the same way that the standard European-style, Canadian, Australia, all these value-added taxes all over the world are destination-based, there'd be the way we would do it here, no deduction for imports. So any importing firm, because they're not getting any deduction for these imported inputs, they're going to be paying enormous amounts of tax. And so there's been a lot of discussion about the Koch brothers, who apparently are in that category, not liking this, right, because of that feature. And export revenue is not included in the base. Right? So all of those firms that are engaged in domestic productive economic activity and exporting, they're going to have a lot of costs, but they're not going to have a lot on the revenue side. They're going to be, show big losses. And yeah.
The understand this. Wages.
Yep.
If I'm living in Watkins, higher than $1,000, I don't get a deduction. They don't get a deduction. But if they go outside the novelty and the novelty unit, and they pay a novelty, how does that work? Do I understand?
Yeah, well, so for this particular tax, remember, again, it's only corporations, right? So, I mean, there's kind of, and there is a deduction for wages, right? So, but if you're talking about, a standard value-added tax that applies, like, to all firms, not just corporations and all, it would be all partnerships, LLCs, et cetera, like a cash flow tax like that where there is no deduction for wages, then yes, you would get a deduction if you go hire somebody else. But there's no deduction for hiring within your firm, right? But, that's the notion there is that, the tax is being picked up somewhere in the economy, and it's flowing since this, in theory at least, the tax would apply, if you do it right, to everything, all kinds of firms, all goods and services, and then it just flows through to the prices that firm charges. Right? That's the notion. And it's not, I don't think it's a, outlandish, ivory tower silliness. There's plenty of that, don't get me wrong. But, this is, again, it's the most common tax in the world, right? The value-added tax. So we have a hard time, I have a hard time kind of getting my head around it when my mindset is always about income taxes, the corporate income tax, and the returns that, the Form 1120 that the corporation files and the partnership returns that go out to him. So it's you kind of have to adjust your frame of thinking about the world to see. I mean, a similar proposal came up in California in 2009, this thing called the Business Net Receipts Tax. And the very point that you're making was one that was part of what killed it, right? Is that there was no deduction for wages in that Business Net Receipts Tax. And so people were saying, well, okay, then what are you going to do? You're going to hire independent contractors instead. And there was some truth to that, but the tax gets picked up on that side then. So it's, in that setting, it was a little trickier because of the interstate dimension to it. Anyway, on this specific tax, again, the kind of border tax adjustments of these value-added taxes throughout the world are exceedingly common and well accepted by all of our global trading partners, and have been given the blessing from the World Trade Organization as being consistent with the rules of international trade as promulgated by the WTO. This is not the case, however, for these modified types of taxes like this one, right? So there's some very significant legal risk that the border-adjusted destination-based corporate cash flow tax, as being proposed by the House, would be ruled to be inconsistent with the WTO international trade rules. A lot of people think that could kill it. Let me skip over that. Here's another thing that could kill it. Yeah, David. It depends on the country, but yeah. So in this case, the idea would be it wouldn't quite be a VAT, but it would completely replace the corporate income tax. And you can kind of see here, this is the one that I skipped. We have in all of these major OECD countries corporate taxes that for the most part have a rate much lower than the top corporate tax rate in the United States, which is 35%. They have it there 39%. I guess they're tacking on, maybe state corporate income taxes. But all of these, so if you look at the United States there, we have the highest corporate income tax rate, and we don't have a value-added tax. Right? All of the other countries, as you just said, have a value-added tax, and then they have a lower rate corporate income tax. That is, unlike ours, those corporate income tax are territorial-based. Ours is a worldwide tax with a lot of complications relating to the taxation of income earned abroad and the deferral associated with earning in foreign subsidiaries and whether you'll ever be able to get that money back in the United States. And we have all this talk of repatriation, holidays, et cetera, et cetera. So the House proposal is basically kind of coming out of this picture. Right? It's like our corporate tax rate is too high relative to the rest of the world, and we don't have a value-added tax. So rather than just doing what France does or what Germany does, right, we're going to have this kind of hybrid type system because we have a political allergy here in the United States to value-added taxes. Democrats don't like them because they're regressive. Republicans don't like them because they're kind of, machines to grow the size of government. Right? They're associated with the largesse of European welfare states. So the old line is when Republicans figure out they're regressive and Democrats figure out they can fund a welfare state, then we'll finally get a value-added tax. Right? Or in the meantime, we might get some kind of hybridized version. So this is just, last Tuesday, we had our first, this is before the inauguration even, Trump throws cold water on the destination-based border-adjusted corporate cash flow tax, the VAT. Right? He may have killed it. He trashes it. Tax reform plans face many hurdles, including Donald Trump. So if you don't have, this is the final and perhaps most important veto in the whole legislative process. If you don't have the president on board, it's hard to imagine this gaining the momentum that it needs. On the other hand, he then a few days later said, well, nothing's off the table. It's on the plate. It's still there on the plate, right? So we might have a tasting, perhaps. It's still on the plate. So who knows, right? There have been some suggestions that perhaps he's a little fickle. I don't know. I'm just saying what I've heard, right? Maybe he'll warm up to the idea. I don't know. In the meantime, just yesterday, this is kind of in the category of new, really new news. Of all people, Grover Norquist, right? Americans for Tax Reform, that's sort of the man who is the principal architect of the Republican opposition to any kind of tax increase for anybody, says, yeah, I think it's actually a pretty good idea. It's a powerful vehicle for promoting economic growth in the United States, is what he says there. He was about to say that when I did the screenshot, right? You could tell it was sort of an awkward shot there. So what's going to happen? Well, I thought this headline kind of perfectly captured where we stand. Certainly it's the case that the GOP is ready for tax reform. They've got these everything's teed up here, ready to roll with these different proposals. But tax reform is hard. It's hard. Roadblocks from special interests, right? People who are, for that plan in particular, right? The importing community will probably come out in full force against it. For the individual stuff, the states that have the highest state and local tax burdens are going to come out against it. There are going to be people lining up to make their opposition extremely vocal in the coming months as this approaches reality. Internal congressional differences, of course. Right? So even if you had unanimity, which we don't, right, there would be a lot of obstacles. But we don't have unanimity. Right? We have a different perspective coming from the Senate, then from the House, then from the White House. Some differences. They're all kind of in the same direction, but they're still different. And plain old math. What does the plain old math mean? Well, you saw yesterday the headlines around the country. Congressional Budget Office issued their projections about the national debt over the next 10 years. And the key thing here is this $10 trillion increase in the national debt is based on current law. Current law. Right? So in other words, if we don't do anything, then our national debt's going to increase by $10 trillion over the next 10 years. That's if we do nothing. And the things that are on the plate right now, in particular the Trump tax proposals, would exacerbate this very considerably. So the most sophisticated running of the numbers to figure out revenue projections for the Trump tax proposals have come from the Urban Brookings Tax Policy Center in Washington, D.C., and they now, basically at the sort of relentless insistence of Republican advocates of tax reform, they now do both static and dynamic scoring of these tax proposals. And the dynamic scoring that they do is based on the Penn-Wharton budget project model for dynamic scoring. And even under the dynamic scoring model that the Tax Policy Center did on the Trump tax proposals, there would be a reduction of roughly $7 trillion in revenue over 10 years. And so this dwarfs the Economic Recovery Tax Act of 1981 or the Bush tax cuts in 2001 and 2003. This, that is tiddlywinks compared to the tax cuts that we're talking about. Now, it's possible that you could reduce spending by the same amount. There's no appetite for reducing military spending. In fact, all signs point in the opposite direction. We're likely to increase military spending. There's not a lot of appetite for reducing spending on entitlements, Social Security and medical and Medicare. And so how might we reduce spending? Well, the National Endowment for the Arts, we could save $123 million there. That's with an M. Things like that. But of course, that's just the tiniest drop in the bucket. I show this to my students. They have no idea what it is. Right? But I don't have the video. Did I when you were in my class? Did I? I'm just a Bill, yes, I'm only a Bill sitting here on Capitol Hill. I'm definitely not going to sing it. All of this stuff, it's not even, at this point, it's not even a bill. Right? We don't even have a bill. Right? So all we have are these kind of vague, we do have some detail, but no statutory detail, which is what the lawyers want. Right? The lawyers want to know, show me how it's going to work. Don't just talk about how you think it should work, and show me how you think it's going to work. And that's a totally different thing. Once we get a bill, at least we'll be able to evaluate it in that sense. But then when it's a bill, here's the process that it has to survive. Right? And basically, it gets introduced, and there are, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, a double-digit number of moments where it can die. Right? So this is, one of the main reasons it's hard is that we have a constitutional procedure for the enactment of legislation that by design makes it hard. Right? There has to be really pretty extraordinary consensus around some particular set of ideas for that bill to get the Gold Star badge to become a law. I've got to be, I love these prediction markets. I don't know why I'm drawn to them. I was following them obsessively. I didn't invest anything, but obsessively during the campaign. And of course, they all had Clinton winning. And so it was kind of interesting to watch how it changed over time. So take it with a grain of salt. They had Clinton winning, right? So they actually have on the predictit.org, they have some markets up where you can buy shares in particular legislative outcomes. And so I plucked off of their website the other day, so this is a few days old, the prices that the people are paying now to make these bets, these investments bets, for will the top individual tax rate be reduced? The prediction markets are saying probably yes, right? It's more precise language than that, right? If you actually click through to the small font where they're telling you how the condition is actually satisfied, it's very, very precise. And it's not at all what I'm suggesting there, and right? It's more, but it is 2017, right? So one of these, the 18% there that you see that suggests that it won't happen, is probably, they'd probably bet, okay, within 2018 maybe, right? Remember the Tax Reform Act of 1986, that was the second term of an extremely popular president, right? And the second year of the second term. This is the first year of a somewhat less popular. I'm trying to just sort of compare Reagan and Trump, but I don't want to be partisan here. Will the top corporate rate even higher? Right. So there's a lot of push in that direction, and then something I haven't talked about, but I'll just put it up. There's a carried interest, right? This is, has to do with the 2 and 20, the way hedge fund managers are compensated and have carried interest taxes, capital gain rather than ordinary income. And this Trump himself has made a big deal about this. We need to get rid of this loophole. A lot of people agree, but its chances seem to be kind of gradually diminishing since the election. So, do we have a? If anybody wants to ask questions, I'm either happy to take them or take them later.
Any questions? Thank you very much.
Great.
Any questions?
Thank you very much, and thank you for hosting me to the UCLA Alumni Association, and also to the wonderful folks at Latham and Watkins. And yes, question over here. State tax. Oh, estate tax. Yes, I had that in an earlier slide, but I didn't say anything about it. I'm giving this same talk tomorrow to the Society of Trust and Estates Practitioners in Irvine in Orange County. And, all three of the, sort of Senate Finance and the House GOP and Trump, they all say they want to repeal the estate tax. Probably the major difference is that Trump says that they will tax capital gains on death. Right, meaning eliminate stepped-up basis. Well, you eliminate free stepped-up basis. Presumably you get a stepped-up basis by virtue of having paid the tax. Right. The House proposal does not have that. A lot of complications there about if you're going to tax gains at death, what happens if you gift property prior to? There's a lot of details that have not been sorted out. But everybody seems to want to repeal the estate tax. So. I don't know about a partial step up. There's talk of an exemption level for, I think, $5 million and $10 million, property up to $5 million and $10 million, that would, yeah. So that, I think I probably got that information from the Tax Policy Center's lengthy discussion of the revised Donald Trump tax reform proposal, which itself is drawn from campaign documents and also from like speeches that were given. So it's not, there's no legislation, there's no actual like legal source for this stuff. It's just. Is estate tax repeal likely to happen? Oh, the step up, yeah. It's hard to say. Yeah, I mean, I don't know if you're talking about the more recent situation with the disaster or the disaster back in the 1970s, where they introduced, there was a law introduced to move from step up basis to carryover basis that was then subsequently repealed retroactively, so as though it never existed. So yeah, that's really been an extremely hard thing to carry off. Right? It's tricky, and I think the in some ways Trump has put a little bit of a target on his own back by populating his cabinet with so many wealthy individuals. It's going to be kind of an obvious rejoinder to these proposals to repeal the estate tax, to say that this is going to benefit his cabinet. I'm sure somebody will calculate the precise figure for only his, specific cabinet members, right? And it's going to be some phenomenal number. Yeah, Jim. Yeah, and there are some links in there as well. Yes, sir.
Number one, is AMT repealing AMT on any of the proposal? Number two, can we look at the VAT as an equivalent of charging a customer on every bill?
So the two questions were, number one, is the repeal of the alternative minimum tax on the table? And the answer to that is yes, absolutely. In fact, it's a feature both of the Trump proposal and the House GOP proposal. That doesn't necessarily mean it will happen, but there it is. That's one of the points that should be made about that is that the most important tax preference item under the alternative minimum tax is the deduction for state and local taxes. So most people who are subject to the alternative minimum tax are subject to it because they have large amounts of state and local taxes. Because the House GOP blueprint proposal repeals the deduction for state and local taxes, you might say that, we're not actually repealing the AMT, we're adopting the AMT. Right? That's not exactly fair because there are a lot of differences from their proposal in the AMT. But, that most important feature of the AMT is a central feature of their individual income tax proposal. So, and for the value-added tax, the question was, is border-adjusted value-added tax like a system of tariffs? And I'm going to sort of beg off a little bit on that. I think that requires more of an economist's mindset than a law professor. Although my familiarity with the work on this is that no, it's not actually. Right? It's actually if we have all of the countries in the world on this same destination-based system, then it's what we're doing is we're taxing consumption where it happens. And we're not specifically targeting imports or exports. We're just offsetting tax burdens with these adjustments so as to make the flow of commerce insensitive to differentials in tax.
My intent was just saying that based on the current system of let's say, European countries charging the VAT and we don't,
Yeah.
It's like they're charging us a custom.
Yes.
And we're not.
I see what you're saying. Yes. Yeah. Well, that's actually, so that it's a nice point, right? And it's a point that, that Trump himself made during the campaign, that, our imports are taxed, when we sell stuff into Europe or South America or Asia, but the stuff that we're importing from them is not taxed. And so the notion here is that by introducing these border adjustments in the corporate cash flow tax, we would level the playing field. This is to be distinguished from a world of sort of specifically targeted tariffs on specific industries or specific goods and services that, frankly, sounds more like what Donald Trump wants to do, right? I don't think he's interested in a sort of elegant, neutral system of border adjustments. I think he wants to have the weapon of punishing certain countries or certain industries or even certain companies. And so that may be one of the reasons why he's not too crazy about the border adjusted system. Yes, sir.
So the inability to write off state income tax.
Yes.
Do you think that will propel businesses actually individuals to lower tax states, territories, states, and with that, is it a fair assumption that in time maybe state taxes across the country become equivalent?
It's a nice point. The question was, with the elimination of the deductibility of state and local taxes, would you expect there to be sort of a migration effect where individuals from high tax jurisdictions might be more inclined to move to low tax jurisdictions on the theory that they're kind of more exposed when they don't have the deduction? It's an empirical question, so we'd have to look at that. The people that I know that look at the effects of state income taxes on migration and have looked specifically at the effect of so-called millionaires' taxes, both in New Jersey and in California, have not found a significant effect. It's not to say that there's not an effect. It's that they've not found a significant effect. Now, part of that might be because of the existence of the deduction, so they're sort of shielded essentially from, 40% of the cost of the tax increase by virtue of the reimbursement of that 40% by the federal government. So in the world that you're positing, it's possible that there could be a different, it might play out slightly differently. On the other hand, you might expect state governments to respond through the adjustment of their tax burdens to the repeal of the deduction. There's a lot of research about what happened in the wake of the 1986 Tax Reform Act. How did states change their state tax structures in response to the new non-deductibility of sales taxes immediately following? And there was a response to that. So, it's clear that state and local governments at the margins are sensitive to the tax price effects of the existence or non-existence of the federal subsidy. Right? So maybe prior to there being a migration effect, you could imagine, for example, perhaps a reduction in the top rate in California in response to that. That would be one of the concerns that people who want to preserve the deduction might express to say, like, we need to continue to support this activity, not deny it the federal support that it currently has. Yes, sir. Yes. Right. Right. Yeah, I think those are both good points. So the first one about the sort of interaction, what happens if we have a federal value-added tax? Of course, we currently have retail sales taxes in 45 of the 50 states. How do those interact? How do you pull off a system of kind of concurrent but differently designed consumption taxes at different levels of government? The one point that I would make in response to that, which I think is consistent with your apprehension about that topic, is that when Australia and Canada adopted their value-added taxes, goods and services tax, those changes were accompanied by wholesale reform of their system of intergovernmental revenue sharing. And so it is almost always the case in a federation that the adoption of a consumption tax at the federal level raises this question about coordination with subunits of government, provinces, states, local governments. And those are countries where the central government has broader fiscal powers over subnational governments than what we have here in the United States. So I see our federal system of government as more likely to be an obstacle to the adoption of a federal value-added tax than what we see or have seen in those other countries for the reasons that you described. And I think the second point is also a good one. It's true, if we're replacing the corporate income tax, this, in effect, what you're saying is you're sort of channeling what I can imagine the World Trade Organization saying about the destination-based corporate cash flow tax. It's like, no, this is not a standard value-added tax, right? This is something different. You are replacing your corporate income tax, and so we view this as wholly different from the blessing that we gave to border-adjusted value-added taxes. So, there was a reason when people talked about the flat tax and the X tax back in the day, it was oftentimes pitched more as an origin-based tax without these border adjustments, and that didn't have the same, positive growth effects because it was an origin-based tax. On the other hand, it was sort of assumed that that's the only way you could do it because of the WTO rules, right? Well, now we're suggesting that we might be able to pull off a destination-based tax without going to a full-fledged VAT. And it just may be the case if, on the other hand, Trump may say, who cares what the World Trade Organization says? That seems like a likely response, right? So if he gets on board with the House proposal, he may just junk the World Trade Organization, right? So, there have been some headlines about global trade wars and things like that. So not out of the question. Yes. Yes. Yeah, the 15% rate. No, I don't think so. Yeah, the scoring for the Trump plan that's coming from the Tax Policy Center is based on the version that they presented in September that you're accurately describing in my understanding, which is that it's applies to all entity forms, right? That it's more about business income, right? Regardless of the form of entity that you're using, it's business income that gets this 15% tax. Now, there was some concern that why would anybody subject themselves to a top individual tax rate of 33% if there's this business tax rate available of 15%. The Kirk Stark Incorporated is going to enter into a contract with the University of California to provide services, so that I can have my own business, right? You can see how easily you might think about this. So I think this notion of retaining earnings was a sort of a modest gesture in the direction of trying to answer that, but I don't think it was ever really fully and completely answered. We're really kind of at the point of sound bites in talking about a tax system. It's not fully fleshed out by any means. Yes, sir. Yes. Yeah, there was a shift in the wake of the 1986 Tax Reform Act because of the change in the differential tax rates that existed prior to 86 and post 86, and the S corporations have been very, very popular. And in fact, it's even skewed our understanding of inequality because previously a lot of income that was reported by corporations is now getting flows through to on individual returns. So if we're using tax data to measure inequality, so yes, I think that experience provides some sort of a framework for trying to think about how differential individual and business tax rates is likely to inform behavior. The one thing that kind of remains true through the millennia is if there are two tax rates and one is more than double the other, then whatever it takes to pay the one that's less than half, people will kind of move in that direction, right? Not instantaneously, not automatically, not universally, but gradually over time, kind of human activities kind of migrate in the direction of tax minimizing opportunities, and that's maybe the best comment to end on. Unless we are supposed to stay here for the rest of the afternoon, which I'm happy to do.
No, I mean, as a CPA, we always appreciate somebody making this stuff interesting. So we appreciate your help, and we appreciate Latham's sponsoring. And Joel he's going to talk about the MCLE issue.
I negligently did not bring the forms for the MCLE credit with me. So what we'll do is we will send each of you an email asking you if you want MCLE credit. If you would just send me back to the institute, your bar number, because we need that for our records, and we will email you the MCLE certificate. And also, subject to Jim Barrall not asking me to put the entire tax code up on the LMI website, we will also give you the link to the website where we'll have the slides and any other documents that Professor Stark wants to put up, so you can access those quickly. Thank you.